Welcome back to the Deep Dive. Today, we are opening up a file that, and I don't say this lightly, feels like the season finale of a show we've all been watching for like 10 years. We are looking at the Cigna Group, specifically their Q4 2025 earnings report. It dropped this morning, Thursday, February 5th, 2026. But look, if you think we're just going to read through a balance sheet and talk dividends, you are in the wrong place.
It is good to be here. And you are so right. If you look at the documents, the transcript, the press release, the filings, this is not just a quarterly update. It really feels like we're witnessing a genuine pivot point in the history of American healthcare. The tectonic plates are actually moving.
Exactly. I mean, usually these earnings calls are a total snooze fest, lots of synergies and optimizing workflows. But the CEO, David Cordani, he used a phrase right at the top that it stopped me in my tracks. He called this moment a clearing event.
That is a very specific, very deliberate choice of words.
It sounds so dramatic, doesn't it? Like the smoke is clearing after a battlefield or, the dust settling after a huge demolition.
Well, just consider the context. Think about what happened in just this 1 week. Here in early February 2026, you have this earnings release, sure, but you also have the culmination of major federal legislation on pharmacy benefit managers, or PBMs.
Right.
And then literally yesterday, the announcement of a massive global settlement with the FTC. It's a convergence. Regulation, legislation, and business strategy are all just colliding.
So our mission today is to unpack that collision. We need to understand how this massive company, I mean, we're talking a $275 billion giant, is pivoting its entire model for how drugs get paid for. And I really want to get into the weeds on this because, frankly, the numbers on the cost of care in this report are terrifying.
It is the story of a company trying to position itself as the solution to a problem that's just getting exponentially more expensive every single year. But to understand the solution, you really have to understand just how bad the problem's gotten.
Okay, so let's start with a scorecard, just to get a baseline. Cigna isn't small. They're a beast.
Oh, they're massive. For the full year 2025, they pulled in, $275 billion in adjusted revenue.
Billion, with a B.
Yeah, exactly. And that's 11% growth year over year.
And they're making serious profit on that.
They are. Adjusted earnings per share came in at $29.84, which is a 9% increase. And looking ahead to 2026, they are projecting revenue to hit around $280 billion, with earnings per share climbing to at least $30.25.
Okay, so the business is healthy. Shareholders are happy. But here's where it gets interesting, and honestly, a little dystopian for the average person. On the call, the CEO, David Cordani, talked about this supply versus cost paradox.
This is a critical concept to grasp. I mean, it goes against everything we learned in Econ 101 and almost every other industry, electronics, clothing, food. When you increase supply, competition drives costs down.
Right. If 10 coffee shops open on my block, the price of a latte should, theoretically stay competitive or go down because they're all fighting for my business.
Exactly. But in healthcare, we're seeing the complete opposite. We have more supply, more drugs, more innovations, more facilities, but the costs are just skyrocketing. Cordani dropped a statistic that I circled in red, underlined, and put a star next to. Since the year 2000, the cost of a hospital stay has increased more than 220%.
220%. That's wild. That's outpacing inflation, wages, everything.
It gets even starker when you look at pharmaceuticals.
Oh, I saw this one. This is the stat that made me actually angry. Lay it on us.
The median price of a new drug launch, according to 2024 data, the median price for a new drug launching into the market was over $370,000.
$370,000. Let's pause on that. That's the price for one patient.
For a single course of treatment or maybe a year of therapy. Compare that to just 20 years ago where that number was around, $2,000.
That is absurd. I mean, from $2,000 to $370,000 in 2 decades. How is that even sustainable? Who is paying that?
I mean, you are.
I don't have $370,000 lying around.
No, but you pay premiums. Or your employer pays premiums, which, comes out of your potential wage growth. This is the pressure cooker Cordani is talking about. You have incredible innovation. These drugs are curing diseases we never could before, but the price tag is breaking the bank for everyone. And even if you never take that drug, your insurance premiums went up 12% last year to cover the risk that someone else might need it.
So Cigna is trying to position itself not just as the insurance company that pays that insane bill, but as the counterforce. Which brings us to the big news, the clearing event. We have to talk about the FTC settlement. This was announced literally the day before the earnings call.
This is so significant. For a long time, the Federal Trade Commission has been investigating the PBM industry, the middlemen who negotiate drug prices. You had lawsuits over insulin prices, investigations into business practices. This global settlement, it resolves all of those PBM matters for Cigna.
And it's not just a "we promise to do better" slap on the wrist. There's real money involved here.
Correct. The settlement outlines about $7 billion in out-of-pocket relief over the next 10 years. That is projected to help about 100 million customers.
And specifically, they mentioned insulin, right?
Yes. A major focus is on lower insulin prices and also reduced costs for brand-name meds right at the pharmacy counter.
Okay, but I have to be skeptical. I mean, we've heard promises about lower drug costs for years. Cigna didn't seem scrambled by the settlement. It almost felt like they were waiting for it. They kept talking about this new model they've been building since early 2025. Is this actually new, or is it just a fresh coat of paint on the same old broken system?
That is exactly the right question to ask. They call it the rebate-free model. And to understand why this matters, we have to understand the old way, the rebate way.
Okay, let's unpack rebates and spread pricing, because this is where people's eyes glaze over. But it is literally how the money has been moving for decades.
Right. So historically, a PBM like Cigna's Evernorth would negotiate with a drug manufacturer. The manufacturer would say, if you put our drug on your preferred list, we'll give you a rebate, money back.
Which sounds like a kickback.
It creates a perverse incentive, right?
Yeah.
The PBM actually makes more money if the drug is more expensive because the rebate is bigger. And then there's spread pricing.
I want to use an analogy here to make sure I get this. Spread pricing sounds polite, but it's basically arbitrage, right?
Yeah.
Let's say I go to a deli. I buy a sandwich for $5. I walk back to my client and say, here's your sandwich. That'll be $10. I pocket the $5 difference. That's the spread.
That is exactly it. In the old model, the PBM would pay the pharmacy one price for the pill, charge the employer a higher price, and just keep the difference. It was opaque. Nobody knew the sandwich actually cost.
And that is what everyone, the government, employers, patients, has been screaming about.
Exactly. It lacks transparency. So Cigna's new model, which they announced back in October 2025, it scraps that. It's moving to a fee-based system.
So how do they get paid if they aren't marking up the sandwich?
They charge a core admin fee. It's a set fee per member or per prescription. And crucially, it's delinked from the price of the drug. So Cigna doesn't make more money just because a drug costs $370,000 instead of $200,000.
It seems cleaner.
It's much cleaner. It aligns incentives. Plus, they get fees for certain clinical programs where they take on some of the risk.
So if I'm hearing this right, the idea is that when I go to the pharmacy counter, I'm getting the lowest possible price, whether that's the negotiated rate, the cash price, or my copay, without all these hidden rebate games in the background.
That is the promise. And Brian Avonco, the president and COO, was very clear on the timeline. This is not a pilot program. This starts January 1st, 2027 for their own Cigna Healthcare fully insured book.
Wow.
And they expect 50% of their Evernorth business, that's their external clients, to adopt it by the end of 2028.
So this is happening. It's the new standard.
And it aligns perfectly with the federal legislation that passed earlier that week. It's a rare moment where a company's strategy and federal regulation are actually rowing in the same direction, but there is a cost to going legit.
You're talking about the Switzerland footnote.
Yes, the Ascent GPO.
Which stands for Group Purchasing Organization.
Right. For years, Cigna, like many others, had these purchasing capabilities based in Switzerland.
Why Switzerland? The chocolate.
The taxes and the regulatory privacy. It's a classic corporate move. But as part of this whole clearing event, they are moving those capabilities back to the United States.
And does that hit their wallet?
It absolutely does. Management noted this move could raise Cigna's effective tax rate by up to 1% over time. Think about that. A company is voluntarily making a move that raises their tax bill.
Why would they do that? Companies hate paying taxes.
Because the price of admission for this new era is transparency. You can't claim to be transparent and rebate-free in the U.S. while running your purchasing through a Swiss entity to hide the margins. They realized the regulatory heat was getting too hot. It just wasn't worth the PR nightmare anymore. They're trading tax efficiency for regulatory survival.
That is fascinating. It's like they're admitting the game is up.
Yeah.
Okay, so that's the regulatory landscape. But let's look at the growth engine. Because if they aren't making money on the spread anymore, and they're paying more taxes, how are they growing?
Volume and services. The star performer is Evernorth, specifically the specialty and care services.
I saw that revenue for that segment grew 14%.
And specialty scripts were up 13%. I mean, this segment now represents about 35% of the total company.
35%? That's huge. And this brings us back to those expensive drugs, biosimilars. This seems to be the buzzword Cigna is betting the farm on.
It's the biggest opportunity for savings. A biosimilar is basically a generic version of a biologic drug. Biologics are those complex, expensive $370,000 drugs we just talked about. When a patent runs out, biosimilars can come in.
But explain the mechanism here. How does Cigna make money by offering a cheaper drug?
They become the gatekeeper. This is the power of the platform. Cigna can go to a manufacturer of a biosimilar, say a copy of Humira, and say, look, we manage 100 million lives. We can switch a huge chunk of them to your drug tomorrow, but in exchange, we want a rock bottom price.
So they're the bouncer at the club. They decide who gets in.
Exactly. And because they control that volume, they can extract deep discounts. They gave a specific example with Humira and Stelara, two massive drugs for inflammatory conditions. Cigna offers access to what they call $0 out-of-pocket offerings for these biosimilars.
Which saves the patient thousands.
Thousands for the patient and millions for the employers paying the premiums. David Cordani mentioned that looking ahead, they expect $100 billion with a B in savings for the U.S. healthcare system just from biosimilars in the coming years. They are monetizing the complexity of switching people to these cheaper drugs.
Speaking of complexity, we have to talk about GLP-1s, the weight loss drugs.
Yeah.
Ozempic, Wegovy, Zepbound. You literally cannot have a healthcare conversation in 2026 without talking about them. Did that come up?
It did. It's a massive cost driver for employers. Cigna mentioned a program called EnReachRx. It's designed for pharmacies dispensing these GLP-1s to provide better clinical support. But more importantly for the listener, they've expanded their patient assurance program to cap out-of-pocket costs for these drugs.
Because right now the predictability is a nightmare.
Right. If you're an employer, having 20% of your workforce suddenly go on a $1,000 a month drug just busts your budget. Cigna is selling predictability. They're saying, pay us a fee, and we will manage this GLP-1 wave for you so it doesn't bankrupt your plan.
Now, beyond the drugs, Cigna seems to be trying to branch out into almost lifestyle partnerships, or at least broadening what insurance looks like. I was scrolling through the transcript and I saw a mention of something called Trump RX. Now, given the year is 2026, I have to ask, is this political? What am I looking at?
I caught that too. It's definitely an attention-grabbing name. Based on the context of the report, this isn't a political campaign tool. Trump RX appears to be the brand name for their new dedicated fertility portal, launched in partnership with Evernorth and EMD Serono.
Okay, so Trump, as in the verb to win, to beat the odds. Or just a very bold branding choice?
Likely the former, emphasizing success in fertility, which is a difficult journey. But the substance is what matters. Fertility treatments are incredibly expensive, often not covered. This portal is designed to improve access and offer cash pricing transparency for fertility meds.
That makes a lot of sense. Fertility is a huge retention tool for employers right now. If you offer good fertility benefits, you keep top talent.
Exactly. And they're pairing that with other modern partnerships. Did they mention a collaboration with Headspace?
Yes, the meditation and mental health app.
They announced an industry-first collaboration to provide digital content to Cigna customers. It's interesting to see an insurance giant partnering with a consumer app like that. It feels, well, modern.
It's part of engaging the customer where they are. And speaking of modern, they also launched a tool called Clarity in November 2025.
The name suggests transparency.
That's the goal. It provides cost transparency before you go for the visit. It has a simple copay-only structure, no referrals needed, and they claim it saves clients up to 10% in medical costs because if people know the price, they make different decisions.
It's the Amazon effect. You want to know the price before you click buy, or in this case, before you book the appointment. If you know an MRI costs $500 across town but $2,000 at the hospital, and you see that on your phone, you might drive across town.
And on the back end, they're using AI to clean up the bureaucracy. They mentioned a 15% reduction in prior authorizations over the past year.
Oh, hearing that makes me happy. Everyone hates prior authorizations.
The doctors hate them, the patients hate them. It's the worst part of American healthcare.
Mother, may I please get this medicine?
Cutting that volume down is a major efficiency win. It saves time and it saves money.
So we have the new PBM model, we have the specialty growth, the tech. But I want to look at the business strategy again, because I noticed something about their membership numbers. They aren't really growing the number of people they insure, are they?
No, and that is very intentional. They expect total medical customers to be flat at around 18.1 million.
Flat. Usually Wall Street hates flat. Wall Street wants up and to the right.
Context matters here. They are actively shrinking their footprint in the individual exchange business, the ACA marketplace plans,
Why?
because they expect fewer than 300,000 customers there. They are explicitly prioritizing margin over growth, put it bluntly. They're firing their unprofitable customers.
That's coal, but I guess that's business. Well, the individual market is messy, high risk, expensive to manage. Large U.S. employers are stable, they pay their bills on time, and they buy all those extra services like Evernorth. Cigna is saying, we would rather have fewer customers who actually make us money than a massive empire of customers where we lose a nickel on every transaction.
Quality over quantity.
Exactly. And despite flat membership, remember, they are projecting earnings growth. That implies they are extracting more value per customer through these specialty services and better cost management rather than just trying to add more bodies to the insurance rolls.
And they're confident enough to be spending a lot of money.
They are. Cash flow from operations is projected at $9 billion. They're putting $1.3 billion into CapEx, that's building the tech for this new model, and returning $1.6 billion to shareholders in dividends.
So let's wrap this up. What does this all mean for the person listening? Maybe they're an investor. Maybe they're just someone trying to figure out why their prescription costs so much.
If we zoom out, Cigna is betting that the future of healthcare isn't about hiding costs. It's about managing them transparently. They are transforming from a traditional insurer into really a health services platform.
It feels like the end of an era for the black box of drug pricing.
It really does. And that leads to a provocative thought I want to leave everyone with. If the biggest players, like Cigna, are voluntarily killing the rebate model to survive regulation, we are witnessing the end of how drug prices have been hidden for decades.
The veil is lifting.
It is. But here is the multi-billion-dollar question. Will this transparency actually lower the sticker price on the box? Or will it just shift where the money flows? We know the rebate game is ending, but does that mean the $370,000 drug becomes a $200,000 drug? Or does the system just find a new way to absorb that cost?
That is the worry, isn't it? We might just see the costs squirt out somewhere else in the balloon.
Precisely. Transparency is good. Sunlight is the best disinfectant. But affordability is the actual goal. And we're going to have to watch 2026 very closely to see if one actually leads to the other.
Well, I'm certainly going to be checking my own pharmacy receipts a little more closely after this conversation. I want to see if that spread is really gone.
As should we all.
That's it for this deep dive into the Cigna Group's massive pivot. Thanks for unpacking it all with us. And to our listeners, next time you are at the pharmacy counter, take a look at that receipt. See if you can spot the change. Until next time.